Friends, September has been hot. Inflation reports, unemployment data, and other macro events have kept the market on edge. The key date ahead is the 17th, and it may set a new trend for crypto. Today, we'll break down how the market is reacting to this news, what to expect next, and I'll show my main selection of altcoins that currently look the most promising. In the meantime, subscribe, drop a like, and let's begin. Friends, before we move on to the market overview and then to promising coins, please note that this video is not financial advice. It only reflects my own impressions and market assessment. Always do your own research and invest wisely. Let's dig a bit into what's happening in the global economy right now. Whether we like it or not, macro sets the mood for both stocks and crypto. We'll start with America because we all know what happens in the US is felt around the world. And there are some very interesting signals here. On the one hand, we see the labor market cooling. In August, only 22,000 new jobs were created, far below forecasts. For comparison, in previous months, that figure was in the hundreds of thousands. Employers aren't hiring as actively. Unemployment rose to 4.3%, the highest since late 2021. Here's the crux. The labor market has always been considered the main trump card of the US economy. But now even it is starting to crack. Add to that a data revision. Over the past 12 months, the US actually created almost 1 million fewer jobs than previously counted. That's a very serious signal. The economy looks weaker than assumed. Now another factor, inflation. Yes, we all expected it to keep falling. But in August, the situation shifted a bit. Headline CPI rose to nearly 2.9% year over year. Why? The main reasons are rising food and housing costs. And core inflation, excluding energy and food, still sits above the Fed's target, around 3.1%. In other words, we have a unique combo. The labor market is weakening while prices remain elevated. What does that mean? It puts the Fed in a very uncomfortable spot. On one hand, they need to cut rates to support the economy and employment. On the other, easing could reignite inflation. It's a chess match. Move too aggressively, you lose. Move too timidly, also risky. On September 17th, we'll get the answer which move the Fed chooses. Now the global backdrop. The global PMI in August printed 52.9. That means business activity worldwide is growing overall. But it's not all smooth sailing. The Eurozone is moving slowly. GDP growth is projected at just 0.9% in 2025 and a little over 1% in 2026. The main problem is the industrial giants Germany and France. If they don't pick up, all of Europe will lag. The IMF says plainly, the global economy feels strain, demand is cooling, employment is weakening. Right when geopolitics and tariff wars add uncertainty, markets, as always, reacted instantly. US equities are rising. Both the S&P 500 and NASDAQ printed gains, as everyone expects the Fed to start cutting. The dollar weakened, Treasury yields moved lower. The classic reaction to anticipated policy easing. There's now near consensus in the market. On September 17th, we'll see the first rate cut. By the way, if you want live updates on macro and crypto overall, follow the link in this video's description. There you'll find my Telegram channel where I cover everything very quickly and in real time. What scenarios are possible? Let's break them down. The first and base case, minus 25 basis points. This is the most expected option. It signals the start of an easing cycle without sharp moves. Reaction may be positive. Tech, growth stocks, and crypto get a solid push. But there's a risk. Buy the rumor, sell the news. After a short spike, we could see a minor pullback. The second scenario, no change. That would be a real cold shower. The Fed could say inflation is still too high to act. Market reaction would likely be sharp. Stocks down, yields up, stronger dollar. And crypto, of course, would take a hit. The third, most aggressive scenario, minus 50 basis points. That would be an admission the economy is slowing faster than desired. Likely reaction, an intensification of risk-on sentiment, though the magnitude depends on the tone and data. But a few days later, the market might start worrying about something else. Is the economy too weak? And we could see a partial retrace. Now honestly, what does this mean for crypto? First, a weaker dollar and lower rates usually support demand for Bitcoin and Ethereum, though exceptions are possible. Second, in such moments we often see rotation. BTC dominance starts breaking its uptrend, Ethereum to Bitcoin ratio moves higher, and then alts follow. The most important marker is stablecoins. If their market cap grows and inflows are positive, new money is truly entering the system. Also watch DeFi TVL and DEX volumes. If these metrics rise after the Fed decision, that may indicate strengthening liquidity. The roadmap looks like this. First, the FOMC meeting and Powell's presser. Then the next CPI, PCE, and jobs data. If they confirm cooling, that's a green light for further cuts. Also watch the yield curve, especially 2-year and 10-year bonds. If they steadily fall, that's a persistent tailwind for risk assets. In crypto, keep 4 indicators in focus: Ethereum to Bitcoin ratio, BTC dominance, stablecoin market cap, and DeFi metrics. If all 4 trend up at the same time, it's not just a local bounce, it's a signal we're at the start of a bigger move. Friends, in this video, I decided to show you only half of the coins I personally consider a more conservative choice for a portfolio. These are projects that have already proven their strength and have serious chances to deliver solid growth without the extra risks typical of tiny alts. The second half, more aggressive, higher risk, but with greater X potential, I'll save for the next video. If you want to see that continuation, don't forget to subscribe, like, and leave a comment so I know you're genuinely interested. Let's start with the industry's foundation, Ethereum. It's not just the second largest coin, it's the heart of DeFi, NFT, and Web3. Yes, the cycle was tough, but that's exactly why Ethereum now looks the most undervalued among the giants. ETF inflows have already exceeded $1 billion, and potentially adding staking could turn it into a crypto bond, yielding 3 to 5%. And if we factor in Bullrun's statements about 10 times scaling, it's clear, ETH is ready for a new major phase. Next, Solana, the king of speed and low fees. After a serious correction, many thought the hype had faded, but no. Just in the last month, up 20%. And the main catalyst on the horizon is a Solana ETF. Regulators are already pushing issuers to update filings, and the odds of approval in the coming weeks are very high. Add the possibility of staking within the ETF, and imagine how much TradFi capital could flow in. Now let's talk about Sui. This is a different story. A blockchain built from day one for games, NFT, and instant transactions. TVL has surpassed $2 billion, millions of active wallets, billions of transactions. The numbers speak for themselves. And the biggest surprise, a spot ETF filing on NASDAQ via 21 shares. Institutions are clearly showing they're interested in Sui. Next on the list, Sei. If Ethereum is the foundation and Solana is speed, Sei is a blockchain purpose-built for trading. Finality under 400 milliseconds makes it a favorite for decentralized exchanges and high-frequency strategies, and crucially, regulatory recognition. Sei became one of the winners in Wyoming's state stablecoin pilot, even outpacing Ethereum on technical parameters. Plus, a major Giga upgrade ahead that will further expand its capabilities. Now, ICP, the Internet Computer, a league of its own. Not just a blockchain, but a world computer where AI models can run directly as smart contracts. The network already does millions of daily transactions, has hundreds of thousands of active canisters, and a strong developer community. The key, deflationary tokenomics. The more ICP is used for computation, the less remains in circulation. A rare case where value is directly tied to real usage. And finally, Render Network. In short, a decentralized NVIDIA for rendering and AI. The project is already used in Hollywood, from Marvel to HBO series. The migration to Solana gave it the required speed and scale, And inclusion in the Grayscale Decentralized AI Fund confirmed institutional interest. It's a key bet on GPU infrastructure in Web3. If you're looking for the main DeFi engine in the Solana ecosystem, it's Jupiter. It's the largest liquidity aggregator, pulling from dozens of sources and finding the best prices for traders with minimal fees. TVL already exceeds $3.4 billion. And in 2024 alone, the project generated over $280 million in revenue, with almost half coming from meme coins. That speaks for itself. The most interesting parts are their innovations. Jupiter Light Mode opens the door for millions of newcomers, and the buyback program, 50% of profits, go to buybacks, creates direct upward pressure on price. A rare mix of stable revenue, mass adoption, and aggressive innovation. Hyperliquid is a completely different beast, a decentralized perpetuals exchange that often rivals centralized platforms by volume. Deep liquidity, speed, and low fees make it a magnet for pro traders. The key feature is real yield tokenomics. A significant share of fees is distributed to stakers or used for buybacks. That means the token delivers real income rather than relying on empty promises. Traders get top-tier UX. Investors get a proven business model that already works. And this leads neatly to Ondo. While the previous projects are building a new DeFi economy, Ondo is a bridge between TradFi and crypto. Not just a bridge, but an expressway. JP Morgan, BlackRock, Citi, BNY Mellon. All these giants already work with Ondo. They're not planning to launch RWA someday. They already manage over $1 billion in assets. With a current market cap around $3.3 billion, the upside is huge as tokenized assets start to boom. If you're looking for a fundamental bet on the future of RWA, Ondo is one of the strongest options. Rounding out this part of the selection is Hedera, not just a blockchain, but a unique hash graph enabling ultra-fast, low-cost transactions. Most importantly, its governing council. Google, IBM, Dell, Boeing, LG, Standard Bank. The list reads like a catalog of global corporations. These aren't PR partnerships, but real business already in production. Hedera is used for asset tokenization, supply chain management, and enterprise solutions in the real economy. With a market cap around $10 billion, HBAR isn't a hype play. It's solid foundation for those who believe in broad institutional Web3 adoption. Another coin worth noting is Pyth Network. It's one of the key players in the Oracle space. While Chainlink has long been the dominant standard, Pyth Network takes a different approach. Data comes directly from exchanges and providers, reducing intermediaries. Among recent updates is news of cooperation with government agencies planning to integrate macroeconomic indicators like GDP and PCE into the blockchain. This makes Pyth Network an important bridge between traditional markets and crypto. Of course, there are still questions around risks and token unlocks, but the fundamentals look quite solid. Next is TON, the open network. This blockchain is rapidly growing thanks to its integration with Telegram. That means not only access to a massive audience, but also real use cases. In-app wallets, payment solutions, and a mini-app ecosystem. TON is showing consistent user growth, and liquidity in its DeFi sector is starting to build up. The bet here is on mass adoption, and in that regard, TON truly stands out among other L1s. Finally, Ethena, ENA. This project is focused on stablecoins and yield. Ethena drew major attention with its USDE mechanism, a synthetic stablecoin that doesn't rely on traditional reserves, but instead uses futures hedging. The project quickly attracted liquidity in DeFi and has managed to maintain activity in capital even after the initial waves of criticism. The model still needs to stand the test of time, but when it comes to innovation in stablecoins, ENA is right at the center of attention. Another interesting project is Pendle. Its unique feature is the ability to split any yield-bearing asset into two parts, the principal token and the yield stream. This gives users the option to lock in returns upfront or bet on rising yields. That's why Pendle is already being used in DeFi for LSTS, liquid staking tokens, and RWA products. Liquidity and TVL keep growing, and the model attracts both institutional players and retail traders who want to actively manage yield strategies. And one more from the AI sector, Virtuals Protocol. This project focuses on creating and managing AI agents. The idea is simple. Instead of each user juggling dozens of tools, Virtuals lets you launch personalized agents that execute tasks in Web3, from token trading to information gathering. This isn't just theory. There are already working examples of agents in DeFi and NFT niches. Just as important, Virtuals integrates with other AI ecosystems, building a bridge between decentralized tools and mainstream adoption. So this is only the first part of my selection. It features more stable, proven projects that can form a portfolio's core. But there's also a second half, riskier, more high-octane, with the potential for truly big X's. I'll cover it in the next video if you let me know you're interested. That's all for now. Remember, these are just my thoughts on the market, not financial advice. Always do your own research before investing. Thanks for watching. Subscribe, like, and stay tuned for new coin reviews. See you soon.